Hello, investing friends, friends of financial freedom. Welcome into High Yielders with Joe. I even got the right mic on. Great to see you, friends. Great first inaugural show on High Yield with Joe. Doesn't matter if we can't get out of the gate without the right words, because we got a great show for you. We're going to do real estate. We're going to look at the whole real estate market and say, gee, this is a rare sale. Real estate is not as volatile as stocks, but we'll see the performance of real estate. It has been a terrific, equal or even better performer than stocks. So we'll take a look at, this is a rare sale, and it's going to have the reason for this. There's a reason for the sale in real estate, but it seems that there are some players that are navigating it very well and are being thrown out with the rest of real estate. We see a real opportunity here. And so we got a great show for you. Let's dive into it. Not an investment advisor, not investment advice, #1 ranked stock analyst in the world. And what we're doing here is the best research and analysis for you and me, the regular investor, because the financial media, they lie to us. It's controlled by the hedge funds, the financial interests, but that's okay. We have each other. We have High Yield with Joe, and we're going to do a way better job than those bozos in the financial media ever could. Please hit like and please hit subscribe. This is our first show on this channel. We do Investors Club. We'll have a show every day on that channel. And then we have High Yield every Monday. And so we'll do High Yield on Mondays. We'll do multi-baggers on Fridays. We'll do different shows in between. And so we're going to go deep on a topic each day. So every Monday, we'll go deep on a high yield. Sign up for the High Yield newsletter. We're going to see a report. And to get the rest of the report, sign up for the newsletter. All right, let's dive in and see this. Okay. So this is what I sent to... This is what I sent to the High Yield subscribers. So I have a great report for you this morning, a big opportunity in real estate. Let's begin. And so the first thing we're going to see here is that real estate is a great performer. And when is it a great performer? Well, as we know, as real estate is sort of famously talked about, it's a hedge against inflation. It's a real asset. And so as nominal changes happen to dollar in nominal terms, the value of your real estate is whatever it is. And so if inflation happens, meaning the prices of goods and services go up, well, the price of your rents can just go up with inflation. All things being equal, they will. So it's been a great, seemingly it's been a great hedge against inflation, but it's better than that. It outperforms when there's moderate or high inflation. And that's what we're going to see here from the National Association of Real Estate Investment Trusts. So first, the U.S. is in so much debt that the government simply cannot inflate its way out. The U.S. is in so much debt that the government simply must inflate its way out. And this is not just the U.S. government, by the way. It's the governments all around the world. We're in that, there's cycles, and there's been a lot of debt, and the governments around the world cannot pay it off. So what are they going to do? They need inflation. In order to have their government stay solid. I can't think of the right word, liquid, solid. In order for their governments to stay with merit, they have to inflate their way out. So they can't pay back the debt currently. Inflation, though, can knock the absolute value of the debt down to manageable relative levels. So they'll knock the absolute debt value down, the nominal, they can't knock the nominal terms down, but the absolute value, including inflation, they can knock down. So there seems to be no alternative. There's pretty much agreement amongst all the economists about this. But that sets up real estate nicely. So not only we're going to see that we've got a real great pricing here for real estate right now, but we're also at a moment where we're sort of set up for a great long multi-year, maybe a decades or better run in real estate. Why is that? Again, because the REITs outperform during moderate and high inflation. So U.S. REITs have historically performed strongest relative to equities during periods of moderate inflation. You can see here's moderate inflation. The dark blue is the price of the REITs going up. The light blue is the income. And then here's high inflation. It's beating the S&P again. It's all income. So basically the prices stayed the same, but that income was enough to beat the price and income of the S&P. And even in low income, it doesn't do too poorly versus the S&P. But if we have moderate or high inflation, if the last 50 years is any signal, any guide, then we should have REITs outperforming. Okay, great. So REITs are set up to outperform. Not only that, but real estate rarely sells off enough to give us a good entry point. It's not as volatile as other stock sectors. This is one of those rare times as measured by the VNQ. This is the biggest real estate. This is Vanguard's real estate ETF. real estate's cheaper than it was 5 years ago, and it's 28% down from the top. So over the last 5 years, it's actually down a little. This is the whole real estate market. And then from the top, we're down 28%. And look at, we had COVID, of course, but other than that, this is, real estate's pretty steady. It just sort of compounds, and you don't get a whole lot of volatility. You don't usually get 28% discounts and discounts from 5 years ago. This is a rare moment. It does not get much better than that in this sector. But there is good reason for the current beatdown, namely interest rates. It costs more than twice as much to fund purchases now than it did 2 years ago, as measured by mortgage rates. So we know that interest rates rose a lot, and this is having a huge impact on real estate, especially these real estate investment trusts. A lot of they rarely would pay cash for real estate. They'll finance it, or they'll issue equity, whatever it is. But they'll finance what they can anyway. So when you borrow, it used to be in 2021, people were borrowing at 3% as measured by these mortgage rates. It's up over 7% now. And so the real estate investment trusts, they may not pay that much, but their cost to borrow has gone up with everybody else's. Okay, and so as some borrowing costs jumped from 3% to 7%, cap rates did go up. So rents did go up. So cap rates, when you buy a property, let's say for $1 million, and has a 6% cap rate, that means you're expecting to get $60,000 in rents each year. So you're capitalizing 6% on your $1 million. So what are the cap rates? Well, if we look at the cap rates, multifamily and industrial are both very low, around 5%. So residential, multifamily apartment, things like that, that's probably not going to be outmoded. People are going to need a place to live, regardless of whatever technology comes along tomorrow. Those are very steady things. They're not, if there's a recession, people are still going to need a place to live. So you don't get very good cap rates on them. Industrials are very simple, like boxes. And so they have low cap rates, very quick and easy to put up. Offices, 5.8%. They're significantly higher than the others, but we know work from home has decimated them. And then what's this? Retail. Well, if anybody can survive these high rates, retail's cap rates are almost as high as these mortgage rates. But just notice that these rates are, the cap rates went from like 4%-ish or 5%-ish to 5% to 6.5%-ish, while borrowing rates went from 3 to 7. So borrowing rates went up a lot and cap rates went up a little bit. And it's really the only one based on that, it's retail. Retail seems to be, if there's any good plays in retail, with these high borrowing costs, it just seems pretty darn tough to eke out much of a gain in multifamily or industrial. I don't want to be in office. Retail, though, is interesting. Let's take a look at retail. We know a lot of office buildings are famously underwater right now, meaning more is owed on them than they are worth. So if you buy a house, you got a mortgage on it, and then housing market plunges, you might be underwater because now you owe more than it's worth, and you might walk away and give the keys back to the bank. So that's happening with the offices, giving the keys back to the bank, a lot of the office buildings. So a lot of the office buildings are underwater, and we're going to hear more about this. We're going to hear from Mr. Agree. We interviewed, amazing interview, CEO Joey A. Gree last Friday, and we'll take a look at some of the wonderful insights he had. So we'll hear about some of this balloon financing as how offices, buildings have been doing it. And so seeing as these office rates have some of the high cap rates, it bodes poorly for the other sectors. So the point here is if these guys have the highest cap rates, the offices, or if they have high cap rates and they're in trouble, that bodes poorly for the guys getting the lower cap rates. As these borrowing rates went up, the people that are getting lower cap rates, that's not too good. So that leaves retail. That is the point. Retail has also had strong headwinds like office space as brick and mortar died over the last year or last decade or two. So from 2010 to 2020, real estate in 2010 was represented as 29% retail, and then retail dropped as brick and mortar died because of Amazon, all the way down to 11%. So the retail has high cap rates, but it's because all of their customers go out of business. So you're taking that risk. Okay. So if investors could find any retail REITs that can navigate these waters well, they could enjoy terrific cap rates and a great entry point. And again, we're getting that terrific cap rates because they're assuming the risk of retail. And so that gets us to the best REIT in the market. And for us, it's really head and shoulders above all of the rest, because this sector is head and shoulders above all of the rest. And this stock is head and shoulders above everyone in the sector. So Agree Realty, ADC, has proven their merit here with authority. How? Well, I could tell you myself, but I brought Mr. Joey Agree onto the show and asked him, and he gave us really terrific answers. So here I am asking him about curb to curb. So ADC does triple net leases, all triple net, meaning they don't do the maintenance, insurance, or anything like that. And they're very long leases, usually with investment grade clients. So they just basically take a 10 or 15 year lease from Home Depot or CVS or whatever, and we'll say, see you in 15 years. We're not doing any maintenance on this. When there's a pipe breaks, you don't call us. We're not paying the taxes. We're not paying insurance. We'll just collect the rent and see you in 15 years or whatever it is. So very interesting business. And so that's what a triple net lease REIT is. Triple nets, everything goes on to the tenant, all the maintenance and all that stuff. And then they also only do standalone curb to curb, micro fulfillment. So what he's about to tell us is that all of these companies, they're all fighting for the e-commerce wars. They're all trying to get the market share. They're all losing money in e-commerce. The key is getting customers to come to you. And you can't get customers in the door, but you can get them to come to your drive-through or to your fulfillment, your little fulfillment place in the back or whatever. And so by having the curb to curb, this company has done incredibly well during the retail devastation, because they understood. He's going to tell us they used to be e-commerce resistant, and now it's omni-channel. You have to have businesses that understand that they need to have micro fulfillment, drive-through, things like that, and things are going swimmingly. So let's hear from Mr. Agree.
We used to call things, when I launched the acquisition platform, e-commerce resistant. That was one of the principles. Very few things, if anything, except maybe getting your haircut, is e-commerce resistant. And so what we call today is a brick and mortar omni-channel critical. The future of retail is omni-channel. It's buy online, deliver to your house, maybe one day by a drone or an autonomous vehicle. We'll see when that comes to fruition, but the tests are in place. Buy online, pick up in store. Buy online, pick up at a locker outside the store. We have stores, H-E-Bs and Best Buys, that have exterior lockers. Walmart has their micro fulfillment facility open, so it's micro fulfillment on premises, macro off premises. It's all of these modalities. The real secret is the only one where retailers make money is when you come to the store and actually pick it up yourself.
Yeah.
If you take the cost of fuel today and labor today, the return rates for delivered items today, which far exceed, depending on which category, in-store purchases, it's really a market share game for retailers to try to grab. But even Amazon is trying to get you to the store now. They're offering a $5 coupon at Kohl's if you return. They're trying to get calibrate Amazon Fresh in the right sense. But they all lose money online. And so today, again, with rising labor costs, with rising fuel costs, with inflationary pressures across the board they're all now trying to get that omni-channel permutation correct. And so it's profitable at the end of the day, not just a market share game. And so our focus today is on brick and mortar omni-channel critical. Like you said, it's curb to curb. The advantage of a freestanding building, if you think about a shopping center, if you're in the middle of a shopping center as a tenant today, your front door is for consumers to come in and out, right? The glass sliding doors, vestibule. The back door, or on the back of the shopping center, is trash and deliveries with a truck dock. So you only have two walls. You can't have a drive-through window. You can't have a pickup window. People have to generally walk across a parking lot. So it's not convenient. So what we see today is having that curb-to-curb control and being freestanding is much more amenable to retailers who are destinations unto themselves. Very few people just stroll around the mall or stroll around shopping centers anymore. They get in, they get out, just because of the convenience aspect. But also they control the whole premises. They can add pickup lanes. They can have drive-through windows. They can restripe the parking lot. They can add click and collect lanes like they all did during COVID. And so COVID accelerated all of that. Now the permutation that all retailers are trying to find is what is the right in-store versus delivery and everything else.
Okay, so micro fulfillment, and if you look at this company's free cash flow per share, as retail went from 29% to 11%, they just steadily kept on compounding and compounding. They understood that in the beginning, again, they called it e-commerce resistant, but they understood what was happening, and they just have a great pulse on the industry. So okay, so here we have retail with the high cap rates. So these guys are enjoying high cap rates with these triple net leases where they don't have to do anything. And by the way, that makes them able to be so geographically diversified. They're in 49 states because they don't have to go maintain these things. They just say, see you in 15 years. And so, okay, so all they do is triple net, and all they do is curb to curb, so that you can have these omni-channel retailers. So they've just done a great job with the omni-channel retailers. Okay, what else? Grocery. Grocery is an enormous anchor. So they'll have shopping centers that people will go to for the grocery store. Of course, they call it an anchor. And from what I understand, these realtors, the grocery stores know how valuable they are. So they get really friendly rates, and you don't really make any money on the grocery store, but all the other companies want to come be near the grocery store. And that's how you make the money. Anyway, the grocery has all sorts of new dynamics, and he has a front row seat. Mr. Agree has a front row seat to that. Let's see where grocery is going.
Historically, grocery in this country has been a 2% margin business. It's the most difficult business to run from a retail perspective outside of restaurants. We know what the restaurant failure rate is, right? One out of three make it 4 years, I think it is.
Wow.
Grocery is a 2% margin business. No grocer ever made money in the middle of the store. Boxed canned goods, paper towel, toilet paper, those are all loss leaders. Wow. The end caps and the perimeter of the store, inclusive of prepared foods, produce, butcher, is where grocers make money. Okay. So let's just take the average $100, let's just call it $100 basket at a grocery store. Okay. How long do you think?
We'll skip this here. So we're going to say it takes about 15 minutes to fill the basket. These people are making about $20 an hour.
Let's do 15. It's easy.
15.
It is fully loaded to the company. $. All right. So you said $20. You said fully loaded.
Yeah.
All right. So divided by 4, 15 minutes, one quarter of an hour.
$5.
That's $5. $2 minus $5 is what?
Negative
$3. Yeah. It's minus $3.
Yeah.
So grocery has historically been, outside of this highly inflationary period that hopefully we're coming out of, where everyone was running to the grocery store, having them deliver for food because restaurants were closed.
Yeah.
Has been a very, it's a logistics business at its core.
Yeah.
Especially for large grocers. So the model we just talked about, we did the math on, that you and I did the calculus on, does it work? And so what you see today is a full-blown war. And grocery will turn into a war in this country because of the low margins and the dollars that it takes to invest in three things specifically, unless you're a very niche grocer. Trader Joe's, right?
Right.
Wegmans, H-E-B with a cult-like following, Market Basket, New England.
So grocery will turn into a war in this country. He said it's just beginning, and only survivors are the ones that can invest in the following three things.
It's coming down to investing in the fulfillment. That's why you see we have a white paper on this too. Kroger, Ocado, macro fulfillment. Walmart, micro fulfillment, trying to eliminate the labor costs using investing in automation, fulfillment technology. 2, labor. You have to have employees that care about the store. Yeah. The best retailers in the world, their employees, Tractor Supply says this all their time. Their team members are their customers. It's the same when you go to Costco or Chick-fil-A or Apple. Their team members are their customers. They're ubiquitous. They're one and the same. And 3 is price. Everybody knows in 2 seconds how much something costs right here. And so if you can't invest in price, in fulfillment technology, and in labor today, you've got a big problem. And so what you see from our grocery strategy is we're wholly focused on the biggest grocers in this country that have the balance sheets and the capital to experiment and try to figure out what the future of actually productive grocery looks like. And so the merger you referenced, Kroger, Albertsons, that's just to compete with Walmart. Don't forget, Walmart and Kroger now own their own dairies. They're pumping their own milk to drive margin. Wow. They're pushing all of their proprietary products. It's a price war at the end of the day. Yeah. And as soon as Walmart wants to flip the switch to price war, because one other point, and then I'll shut up. The three largest grocers in this country don't make money on grocery. Walmart, they make money on the hard and soft goods. Grocery is the leader.
Okay. Yeah.
Costco, Costco makes money on memberships, not grocery.
Okay.
Amazon makes money on data and advertising, AWS and advertising.
Right. Right.
And
Right.
so if you're just a traditional grocer today
You're in
and
trouble.
you want to compete against these Goliaths who don't even need to make money in the space and you're in a 2%
Wow.
space,
Wow.
you're in real trouble.
Yeah.
And so that's the grocery space.
Well, then where you went with that was that the dollar stores are becoming they're becoming the new in between trip to the WalMarts.
100%. That's their whole business model, right? They're going to be 20 minutes from the nearest Walmart. They're the fill-in trips. You go to Walmart every 7 to 10 days for the full shop, and then the dollar stores are the fill-in trips. You also have Aldi, which is an amazing operation penetrating this country. You have all of these different competitors nibbling at the edges too. And so it's grocery, I had fully anticipate, although a lot of real estate investors think grocery anchored shopping centers are the most safety, right? The most safe investments. I think C minus and B minus grocers in this country are in a whole world of hurt coming up
Yeah.
because they don't have the capital to invest in those three things.
Wow. So that's pretty insightful for the grocery, which is, again, as he says, is normally seen as a steady, safe thing. The model's going away. None of the big players make money on grocery, and they're happy to do it. They all either lose money or break even. What does that mean for the smaller players? They're trying to make money on the groceries themselves and don't even have the economies of scale of Walmart or whatever. That sounds pretty. Sounds like he's a pretty. Mr. Agree has been very forward thinking. As retail has fallen apart, he's noticed ahead of time what was happening, and he's telling us here groceries falling apart. So good to know. All right. And now, what about drugstores? They also have their they've got their finger right on the pulse of drugstores.
What's happened? And what's happened? Biggest tenant.
Yeah. Got such good insights on the drugstores. I know you think that CVS is crushing Walgreens. You guys got away from Walgreens a little bit. Can you talk about that?
They were my biggest tenant.
Yeah.
I developed 30 of them myself. They're our biggest tenant. And so I've been front row watching what's happened. And what's happened with the pharmacies is the $350,000 to $400,000 per rent per year, $25 to $30 per square foot on the 13,000 to 14,000 square foot box worked historically in this country when you went there to get toothpaste, deodorant, snacks, and all those other high margin items. So 2/3 of the EBITDA from a pharmacy comes from what they call the front end, those types of items. 2/3 of the revenue comes from the back end, the pharmacy, right? The actual dispensing pharmaceuticals. Well, today, I don't know about you, Joey, but when I need toothpaste, I click on Amazon and I click buy again, and it shows up the next day. I don't need to go to the store. Right? The only thing, I'll be honest, the only time I actually go to the pharmacy besides to pick a prescription today is on Mother's Day and Valentine's Day and our anniversary, and it's generally the day of. And those cards are like $9 now. I was like, this is crazy. This is nuts.
That's a margin business. Yeah.
Yeah, that's a margin business. And so the front end sales of these pharmacies, the calibration of the EBITDA drivers are totally off now. So the fixed cost structure of the actual store, their largest fixed cost is their rent, doesn't make sense with the EBITDA and the sales from the front end.
Wow.
You also have pressure on generics, and everyone thought Amazon was going to take over pharmacy, and that never happened. But there is pressure on generics as well.
Okay.
And so CVS was forward leaning. CVS went out and bought a PBM. They bought Aetna. They installed the Minute Clinics, the health hubs. They became a fully integrated healthcare provider. They eliminated cigarette sales. A fully integrated healthcare provider. All the while, Walgreens was trying to buy Rite Aid, add more stores, more fixed cost structure.
Right. So the front end is dead. They made their the high margin items, the toothpaste and things like that, were keeping that was 2/3 of the profits of the drugstores. Nobody goes there for any of that stuff anymore. CVS understood that and decided we're going to become a healthcare company. And Walgreens didn't. They said let's keep on adding more front ends and start to become the biggest front end of drugstores. And they're paying the price. So good to know there. And then this company has had amazing, terrific, great growth, which is all the more incredible given that real estate or that retail has had such a bear market while they've just been growing incredibly. And now their growth prospects look incredible. Healthcare data.
Right.
Yeah. Wow. Very, very, thanks so much. Very interesting. Your growth has been outstanding, and now your growth's been outstanding, but now you see astonishing opportunities for further acquisitions. On the latest call, you said, quote, "We've never seen the diverse set of opportunities that we've seen. The lack of competition in the market is frankly stunning. It's us and sellers' expectations. And so the private 1031 buyer has vanished except the infrequent ones." 1031 is a tax thing where you can switch properties without paying a capital gains tax, right? Yep. So the 1031 buyer has vanished except the infrequent ones. The high net worth individuals, you don't hear about them overly too much. The non-traded REITs, of course, aren't playing in the space anymore. And then the levered private purchasers can't get the leverage. So we really have our choice here, and it's an interesting paradigm to be in. And as I mentioned in the prepared remarks, I've never seen an opportunity so ripe and fruitful with that wide-ranging spectrum of opportunities. Holy moly. Can you speak to the growth prospects and your plans?
The biggest surprise of my career is I never thought we'd be an $8+ billion enterprise and our competition would all be gone. It's the biggest surprise of my career. Our publicly traded listed peers have all gone in divergent investment strategies and directions. The non-traded REITs, the levered purchasers, the 1031 buyers, they're all gone. And so we're sitting here looking at all this broad pool of assets. We're the first and last call, and what has to make sense at the end of the day is price. Right? It has to make sense given our cost of capital. At the end of the day, net lease investing is a spread investment game. Now, give us the stock price, give us the $70 stock price again, we can double this company in 3 years. But again, we're not going to sacrifice quality. That is something we never will, right? This is the best retail portfolio in the country. It started as a distressed way, as we talked about in 2010. I'm not going backwards in terms of sacrificing quality.
Good.
We're Walmart's largest retail landlord. They're our largest tenant, our best relationship. But at the same time, there has to be an appropriate spread. And so, as I said, when you read it back, it's sellers' expectations of pricing. And so every single day, another seller, another owner, another developer, whoever it is, institutional, private, we call them, they wave the flag. We have a wall of capitulation in the office.
Unbelievable.
Every time a seller capitulates, we post the deal on the wall. Yeah, it's a little white flag. We post it on the wall. But at the end of the day, the hope that pricing is going to go back to 2021 and the first 2/3 of 2022 levels, that ain't happening.
Yeah. All right. And then, so as their growth has been incredible. They've thrown off tons of cash. They've just done an incredible job growing the free cash flow and free cash flow per share. They've just done a great job. And it was while retail was dying. And now, though, it seems like it's better than ever. Their outlook looks better than ever. They have no competition. And then, speaking of no competition, a lot of people know about O, which is Realty Income, or NNN, Net Lease REIT. I think that one's just called. And he's going to speak to the competition here. They've gotten so big, is the idea, they can't really stay in their old wheelhouse like he is.
Well, first, there are a lot of good companies in different spaces. This isn't a football game. There isn't one winner or one loser at the end of the day. I had the opportunity when I launched our acquisition platform. It was young back in the day in this business. There were two companies predominantly in the space: Realty Income and National Retail Properties, ticker symbol AAA.
Yep.
I had the opportunity as a 20-year-old in my 20s to watch both of them and take the pieces and parts from both of them that I thought would best formulate a net new blue chip REIT. Now, Realty Income, look, it's a great company. It's a very large company. They have to invest billions of dollars a year globally, casinos, different sectors. We are laser focused on our 30 to 35 sandbox retailers in the United States today, absent Hawaii, but in the United States today, the biggest and best retailers in the country. I'm not focused on Europe. We don't do anything in Europe. Our head of IT is there on a trip with his family right now. That's about as close as we get. We're focused on this. We're not buying casinos. We're not buying industrial. We are retail specialists. But I tell people, investors, all the time, back to Warren Buffett and Charlie Munger, diversification or worsification. Charlie Munger calls it worsification.
Right.
Our core competency here at Agree Realty, my personal core competency and the team I built, and all companies are run by teams of people, is retail real estate. That's our expertise. It's not industrial. It's not casinos. It's not Europe. It's not Italy. It's not Ireland. It's not Great Britain. We stay at our core company. And I tell people all the time, if you want industrial exposure, go find the best industrial management team out there. Maybe it's Prologis. You pick your horses, who you think are the best operators, invest in them. That's not what I'm good at, right? Frankly, I don't know anything about industrial real estate, to be honest. I don't know much. If you want European exposure, find the best European management out
there. So what he's saying is that Realty Income, which is a good one, but it's gotten so big, they've had to go to Europe, and they've had to go to casinos, and they've had to go to all these things that don't have these awesome triple net curb to curb, and that's all they do, and that's all they've ever done. They're experts at it, and now the market looks better than ever. So everybody knows about, that triple net one, it's a monthly payer. This is a triple net one monthly payer. It seems like it's better on every measure, and it's unknown because it's so much smaller. So it's just I think this is just a really good one. Let's keep going. ADC is large and steady enough to earn a credit rating from Moody's and maybe some others, but at least from Moody's and that financial stability. So they've got a credit rating. They're big enough to have a credit rating. It means they can issue bonds, et cetera. They issued the lowest yielding preferred in REIT history. And that's a good thing, meaning they were seen as such a good credit risk. They were loaned money at the lowest rate any preferred ever has. And their balance sheet, by the way, is terrific. But we saw that mortgage rates went from like 3 to over 7. How are they borrowing? Their financial stability means they enjoy excellent borrowing terms, but I'm not going to show it to you because you got to subscribe, and you can see some more charts about where they are relative to their past, looking good, and you can see some more stuff about the insider buying and more stuff about the club. But sign up for that and become a part and join the club and be in the Discord and all that stuff. Let's see if we got some. See if we got some comments. I was out on vacation. Did you change the time and format? So this is, I guess we're broadcasting on both Investors Club and High Yield. So this is Monday's High Yield. So we're going to do a High Yield. Does agree. So we'll do, I'm still setting everything up. So we'll do the market open 7:30 a.m. every day on Investors Club. And one day it'll be High Yield. One day it'll be Dividend Growth. One day it'll be Multi-Baggers. Well, 5 different days. And we'll go deep like we did today. We'll go deep on a topic instead of spreading it around. Richard Pisarski, does Agree occasionally check to make sure their properties are being kept up? Like he says, they have only 30 to 35 tenants. So they're always, they stay in close relationship with all of their tenants. It's not a million different people. It's Lowe's and Home Depot and Walmart and stuff like that. So Kroger. So they keep tabs just like they did with Walgreens, and they got out in time mostly. So they keep tabs on all their companies, make sure they're doing omni-channel things, make sure their finances are good. They do, they keep track of that stuff. Yes, they do. Walmart pumps their own milk. Holy cow. Actually, I've just learned a lot. Thanks, Joe. You're very welcome. We're going to go deep now. We're going to learn a lot. So rather than covering everything, we're just going to grab the most important thing and say, let's go deep. And so I loved this interview with Mr. Agree. Thank you for saying so, Richard. Learning stuff. I think we're going to use this not just for High Yield. He gave us so much good information. We get like with grocery, with drugstore, with a lot omni-channel, with so many different things. I can just see now this. He gave us. He's on the ground. I just thought it was such expert information. So we can now. I feel like we got some really great insight. We can now say, wonder where else we can apply this information. So I thought it was really great too. Thank you, Richard. As soon as some of my stock is about to break even, I'll be buying Agree. The market is in a funk right now. However, good news on Netlist. Yes. Good morning, peeps. I like Agree, and the CEO seems really smart and a great place to park money. He does seem really smart and focused. If you watch the rest of that interview, he said he grew up on a bulldozer. He talks about how his dad was in the business the whole time. His dad was like a big developer of the Kmarts. And then, so they had Kmarts, they had Borders, they had all these other companies that went out of business, but they kept staying ahead of the curve. The retail just had so many companies go out of business, and yet they've just kept doing great by understanding the industry so well. And Ryan says a double in 3 years. And all right, so this is Mondays. We'll do high yield. If you got multi-baggers questions, we'll be in the multi-baggers Discord. But we'll do multi-baggers on Friday. So I see you guys asking questions, but we'll do those on Friday. We'll do those in the Discord. We had a Zoom call for the multi-baggers yesterday to talk about whatever questions people had. It was a great Zoom call. So if you go in the multi-baggers, you can, I recorded that for subscribers, so you can watch that if you weren't able to go. We'll do another one next month. And then this weekend, we're doing a call for high yield. So we're gonna do each service, high yield, multi-baggers, there's others. But each one's gonna have its own Discord for chatting all the time, 24/7 chatting, a weekly Zoom, and then a weekly email like this, where you get the whole report, not just a portion of it. All right, guys, sign up for the newsletter, and I will see you in the Discords, and I will see you back here every Monday, and I will see you in Investors Club every Monday through Friday at 7:30. And I hope you have a great night, and see you in the Discord. Have a great night. See you in the Discord.